The following is a presentation of TFNN.
Good afternoon, folks. Okay, sorry for that technical glitch. I guess we're getting started just about on time. Sorry about that. And a lot to go through today. I wanted to make sure that at least everybody on here did receive the trade update that I sent out probably about a half an hour ago or so, as well as the Twitter alert that was out there. And so what I want to do is we'll go back to the normal presentation. Well, let me just at least put this up here because I know that there's, a substantial number of folks that are joining us by the archive version of this. So welcome to today's February 15th live webcast for Mastering Probability and our Celestial Charting. I do want to get straight to the trade here. Then we'll get back to the normal piece of the presentation. And just to check to make sure everybody out there can hear me okay, maybe just one person or so. I don't know who that one person is, but somebody can just type in that everything is good on your end with regard to volume and everything. Okay, good. Thanks, Bill from New York. So let's quickly just take a look at the charts and take a look at what we are looking at. Right here these are the 10-minute charts, if you will. I'm going to switch over to the daily charts just real quickly. And the daily charts I'm talking about here are on the ETFs for us. And, what we're looking for, just like yesterday, like all of these days here going into the close, sometimes things look like they're falling off the cliff, if you will, during the day. And yesterday was an example of that, was at about 3:30 or so when the markets spiked back up. And so what I'm looking at here is on the SPYs, really on all four of these ETFs. The Qs are the one that are going to be a little bit of the stretch, but it does look like what we are seeing out here today are bearish engulfings, and bearish engulfings on each of the ETFs out here, and we can see in some cases we can see the volume picking up. So in the upper left-hand corner, we've got the SPYs. It's very clear here that right now what you'd have an engulfing of the last two trading sessions. If it can get down below the February 10th open, which is at 134.16, you're only at 134.43, we would have quite a large bearish engulfing out here. The Qs are going to be, which have been the strongest. What we were looking for here, you can see that yesterday the Qs opened at 62.90, and they are trading right now at 62.83. So I didn't think that we were going to get this signal, but this would be, in essence, the best of all worlds because we would have bearish engulfings on the SPYs, the Qs. You can see we do have volume picking up. Certainly on the diamonds as well. The diamonds look like they will engulf a whole set of candles. Now, still not getting down through this breakout area here, but I still at this stage want to go ahead and leave the, as we go into the close, especially since we are doing a live webcast, if there's anything that we see while we're doing it, while we're doing the live webcast, then we can go ahead and enter the trade. Some folks may have gotten in. Well, I don't think that anybody would have gotten in yet if we use the buy point for the buy entry. Now let me just switch back over to the 10-minute chart here real quick. And on the 10-minute chart, what I was looking at is all of these hammer candles and bullish engulfing candles that were occurring just simply intraday. Again, the key was really the daily chart, but if we just come over to the intraday chart just to take a look at what it was that we were looking at, when you take a look at Apple out here, which is obviously the big kahuna, what you saw going on at 1:10 this afternoon was it had this hammer candle, and the low on that hammer candle is 502.08, and in that last trading session you got a close of 502.27. So you still tested the low, but you closed back up above it until that's broken. That area there is a strong support, if you will. We had the same type of things. The diamonds gave it up. The diamonds really had two candles. I'm going to get this out of the way for us. Diamonds had two candles, had this hammer candle. Again, at 1:10, that was broken on the 10-minute chart, but then was immediately followed up with a bullish engulfing candle here. You can see it's broken through there. So diamonds are giving us an indication that, the market is ready to correct. And, we've been patiently watching the S&P and the ascending wedge pattern that was out there. In the case of the TZA, which I have down here, it looks like anybody that did put in a an advanced order. The TZA did get up to the 1950 level just as we were coming on the air a few minutes ago. So if we're in the trade, if you're in the trade, I still think it looks like it's good, subject to something happening in the market as we go into the close. So let's go ahead and continue with the presentation, and I'll just simply watch the screen, or if somebody sees something, just raise your hand and shout out. So what I wanted to do, and welcome all of the new folks. I'm just going to flip through a couple of charts out here. Those of you that have been through a number of these presentations, and all these presentations, folks, they're archived, so they're good to go back through. There are some client questions that did come in. These questions didn't come in until late this morning or what have you, and I'll be able to get to some of these, not all. I do want to leave some time at the end here for everyone that is attending live to be able to type in some questions that we can get to. But always feel free to send in some questions ahead of time if you'd like me to cover some of these areas during the webcast. Our next webcast is set for 2 weeks from today, which is February 29th. And so that does not, to my knowledge, that does not get in the way of my travel schedule. So we're good. Yeah. So we'll be back certainly from the West Coast. So 2 weeks from today, February 29th. This was the lunar trading strategy chart that I do keep track of for us. We'll go to the live version of this. When it comes to really the lunar cycles and being able to identify some trend changes, as you know, the last couple of days, the focus has really been on the perigee and apogee, and we're going to spend some time on that today. For those of you that are new, I do have a ephemeris. I do recommend that you purchase an ephemeris. It's called the New American Ephemeris, 2007. 2020, there's the StarCraft publishing number, and the ephemeris, this is 3/4 of the page. In this area down here where my cursor is at is the moon phenomena that we take a look at. The bottom page is the Daily Exspectarian. The Daily Exspectarian is where on each day it gives you the information with regard to planetary alignments, both major planetary alignments and those that are not major. These are where I develop, or where we develop the P index data to identify whether or not there's an anomaly that's going on. These are the different lunar phases that we take a look at. Our primary lunar phases that we've been focused on have been the full new moon, apogee, perigee, and those have been the primary ones that we have been taking a look at. Going back real quickly here to the Daily Exspectarian, these are the 5 major angles, if you will, just like we use the Fibonacci expansion and retracement. With regard to planetary alignment, we take a look at square, 90 degrees, opposition, 180, trine, 120, sextile, 60, and conjunction where it's back to 0. So those are the 5 major aspects that we take a look at. What I have here is each month, as we do these webinars, I post the entire set of lunar dates and what is occurring there. I believe this is also, now I started including this in the newsletter for each of you. So it'll just simply be a recurring page that is out there. Today being the 15th. You've got the, in all of these times here, folks, these are ephemeris times. In ephemeris times, at this time of the year, you want to go ahead and you want to back up by 4 hours. So it's on a 24-hour scale. Back up by 4 hours, it may take you into the prior day. And when it comes to a weekend, when some event is falling on a weekend, what you don't know is it's a little bit more difficult because you don't know whether to use the high or low of the Friday session or the high or low of the Monday session. So that one takes just a little bit of subjectivity, if you will. There are also, these are the full moon dates for the rest of 2012, and if I'm going through these fast, you can go back through the last webcast that we did. I might do it a little bit slower. You can also, I believe, you can stop this as the if you go back and take a look at the recording. Here are all the remaining new moons for 2012. Here are the perigee phases that we have for 2012. Perigee and apogee phases, I believe I've included all of those for 2012 in the current newsletter as well. And then the phases when the moon is on the equator. This would be for when the moon is on the northern equator, our first and third quarter. lunar phases. We did have a third quarter lunar phase that came in yesterday on February 14th. I didn't really focus much on that because the lunar phases have not been working to be able to identify enough of a turn. And so what I do use either lunar phases or the lunar phases or the planetary aspects for is more of a timing device, not a device. The priority on it is a lower priority than what's going on at price or swing points or patterns. And so this here are the dates for when the moon is on the southern equator. And then here are this is what is showing up in the current newsletter, all of the 2011. Okay, that's what I've done. So I've done the 2011 Apogee and Perigee dates so that you could go back and you could lay these on any of the charts that you might trade. Some of you trade futures, some of you trade commodities, some of you trade different ETFs. I have been using this on the on the ES mini chart so that you can and overlay those. We're going to take a look at those charts today. And so you have all these dates where you can go back and you can lay them out. Now, what I did do for you, just to make the math a little bit easier and to take into account the daylight savings time, I have created Eastern Standard Time. So depending on the charting software package, now we have folks from all around the world, if you will. So, I've done what I possibly can so that you can take a look at Eastern Standard Time, and that's what these time frames are here. The highlighted areas in yellow mean that in this case here, you should look to the prior day. In this case here, would have come in at 2011. Of course, the market was closed. Well, no, 2011, on a Friday. So it would have been closed here on Wednesday, for example, September 28th. You'd be looking at 7:51 p.m. And again, I think this is great to apply to the futures contracts, and you can apply it really to the exact moment, if you will, and just simply draw a line, as we'll see as we come take a look at this. Let me keep coming here. So this is the now. Let's go to the live chart here. So let's take a look at this because what on the very first chart that I sent out, I think I had the line down at the bottom of now this is the last perigee, which came in on February 11th, which happened to be over the weekend. So as I said, the question becomes, where would you put the line, if you will? Would you put it down going into the close of the session, or which would have been Friday, or would you go ahead and would you place it up at the open of the Monday session? And I don't know the answer to that, and probably what should be done is probably both. And that what we know that we would be dealing with, is a range in here that would kind of be a void of unknown or something like that. I don't know what to really name it. And so let me come over to the live chart so we can just simply take a look at that, and we'll do both of that. So I'm going to come back over to the ES Mini here for us just so we can take a look at where we're at. I'm going to get rid of the, got a lot of stuff up here. Let me get rid of these patterns. I don't want to delete everything, otherwise all the work will be gone. So, if we take a look at for the perigee aspect that took place on the 11th, here I've got it at the open, if you will. Let's come down and draw a line from the close. And in this case here, in essence, what we're saying is that when you are trading above this line, what you would be looking for is you would be looking for bullish outcomes. When you're trading below the line, you would be looking for bearish outcomes. And what I'm going to do is I want to go back and take a look at the prior ones, how they've played out. And if you have some questions about it, feel free to send me an email as well. But it does look to me, I have not been able to develop a trading plan from the standpoint of what should you do from a stops standpoint if you were going to go ahead and trade the futures. I think that whether you're trading the futures or you're just trading maybe the ETFs, could be the triples, the doubles, or the singles, you want to be aware of this time frame. And if you're on the wrong side of the trade, I think that it may require you taking some action and maybe taking a tighter stop and taking a small loss if you're on the wrong side of the trade, and possibly getting into the other side of the trade, or waiting, looking for some other patterns. And that's really when I go ahead and I put the studies back up here. If you're going to make this trade, and let's say at this stage you were somehow long, let's just say we were using the close of Friday as the session, and as long as the market were trading above there, you would be looking for bullish outcomes. And I'm not suggesting that you would use a stop so tight. You would give it a little bit of room, but it is no wonder that the highs out here, and again, this is on the 30-minute chart, it is no wonder that the highs out here were stopped dead in its tracks at last night at 10 p.m., because you'll see when I just simply go ahead and I put the studies up there, give this a second, you'll see it was a 1.272 expansion coming into that area. So we can use this to understand, in my opinion, whether you should be long or short the market. And then what you would be using is other expansion or other patterns that exist out there to understand whether to take some profit off the table or tighten up your stops, let the market take you out. And so let's switch from the live chart now, and let's go back to the presentation so we can take a look at the Perogee or Apogee. Apogee, I guess it's the Perogee. Let me see here. February 11th. Okay, that's the same last one. Sorry about that. The Perogee aspect that took place on January 17th. And so in this case here, I believe that this was exact. So this was not on a weekend. And what you can see here is really how, if we use the principle of being, if the price was above, that you would be long, and if price was below, that you would be short. On the last aspect of Perogee, this certainly worked. Now, what I did do was I just simply, it might be easier. Let me try this as opposed to using the presentation, because it might just simply be easier to do. So I'm going to go back to the chart and just simply back up. But I am going to get rid of this clutter for the moment. So let me go ahead and back up the chart here. That way it may be a little bit easier for us to take a look at. So here is the last Apogee. Okay, here's the last Apogee, which came in on January the 30th. I don't have this lined up here, but came in at 1448. I think I have adjusted that 1448 there. The times that I have in there, let me just reach for my sheet of paper here. I believe that is backed up. See, January 30th. So that is backed up for Eastern Standard Time. So as you see these times that show up here right now that I've identified on the chart, I did go ahead and back that for Eastern Standard Time. And so you can see here, as you're looking up in the upper left-hand side, you can see the time frame that shows 14. Actually, so 1448 looks like, let me make sure that's correct, 1348. Should have been 1348, not 1448. Sorry about that. So 1348 would have been the time frame, and I went ahead and used 14, so 10 minutes off, if you will. So so this is wrong here at 1448. Should have been 1348. Bad math on my part. So the line that we have drawn here is correct. And, as we see, as the market moved up, what it did was, 100% move on a 30-minute chart here. So that's just simply a normal trading pattern that we would expect, that you could start to tighten up your stop on that. It comes back. This area here holds as support. Moves back up, comes back down, and tests it, and continues to move up. Does a move here, goes sideways. And so, to identify the different patterns that are out here, let's just continue to go back and take a look at the last aspect, the last Apogee, that would be Perogee now. So let's continue to move back here for Perogee. And so we have one that occurred January 17th. That was one that I was looking at. Let me just go ahead and erase this. And I think that one of the things that I would do if I were trading this here, one of the things that I would be do as I were trading this here, okay, so Apple's under 500, that I would be doing is, in this case here, you can see that how this has acted as support. You can see you made a move coming here, but I would also want to understand the expansions of any of these patterns. And in this case here, I was just simply coming from the top of the swing point prior to the lunar phase occurring and just simply drawing my expansions. And what is interesting as we take a look at this right here, you can see that during the cycle, let me back this up, and the line that I have drawn here, the blue line runs all the way to, is trying to run it as close as I could to the next time that the apogee picked up. But you can see that this thing made an expansion, how it worked, to a 2.618, 1329 of this set of swing points prior to it coming in here. And, clearly the market got up to that specific high. So let me get rid of that for the time being. We'll come back to the next one, which is January the 12th. And January the 12th here, you can see that the market danced around here. So during this cycle here, other than being in the trade and getting stopped out, if you will, a number of times, this really wouldn't have necessarily worked well until you got fairly far into it in the January 9th, 7 days later, if you will. But it is interesting to see how this area here did act once the market did start to move up and it came down. It is interesting to see how this, acted as a support going into this next cycle here. So again, to me, it's a good indication of whether you should be long or short, and at least using this as a roadmap with regard to your positions. If we take a look at the next one that came about, which was Perogee, on December the 21st here, you can see how this area here, marked as a support line, was hit just for a couple of sessions, if you will, and then the market taking off from there. If we take a look at just again using the same expansion from a swing point to a swing point as it was kind of coming into this area, and I'm just simply going to the most logical one. I guess you could use this and or this swing point. So let's blow this up a bit, and we'll use both. If we use the smallest one really from here to here, which is kind of a very small distance to travel. There's not a whole lot there. But if we do come down to this larger set of swings prior to Perigee taking place, what is interesting is that you've got this 1.618 area here of 1265, and during the phase it got up to a total of 1263 up there. A&O is getting close to our buy point. Okay, that's good, and we should buy A&O if our buy point does get hit. So no change in that trade whatsoever. But we can go ahead and we can pull that up. Looks like it's at 47. I think our buy point is that at 44 or 45. I think it might be at 44. Let me keep coming back here. So let's go take a look at the next phase of this, and that would take us back into December 5th, right in this area here. You can see once the market came through with conviction. So if you're going to be using this, one of the things that you're going to have to do is you're going to have to take certainly look at candles as it's coming through this area. That was one of the questions. That was one of the first questions when we were taking a look at client questions. And, and as you are coming through any area that we've identified as support or resistance with a long-range candle, you have to go with that long-range candle as giving you a real identification as to where the market is going. So in this case here, once the market came through on this wide-range candle, it's no surprise that, okay, it moved back down, tested it, and continued a sideways move until it moved up to the top and completed this move of the move coming back here. So I think that utilizing this for your trading is going to be, for our trading, is going to be very helpful. And as I say, even though I'm applying this here to the futures contract because we've got it trading, in essence, all day long, then this should be able to help you with regard to your positions in any of your ETFs, whether you are short or long, and what you might want to do with regard to tightening up stops as you trade. Let me keep coming back a little bit further. So this one comes back to November 8th, and November 8th, again, you can take a look at this. Certainly we had this long-range bar, as you pass through this point, and, it did this move of the move coming back here to this set of swing points, and then obviously continued lower. I'm going to guess here, as soon as we do an expansion of swing points, logical swing points that you would take a look at, what you're going to find out is that, the way that you would utilize this shows that you've got a 1.272 expansion, of a major set of swing points as you came through this area here of support or resistance. Does that make sense? Is this making sense to you folks out there? I hope. So let's go back one more phase here on this, and then we will switch over to the P index dates. So if we take a look at this next set here, let me go ahead and turn this off. So again, we're taking a look at Perogee. This is one from October 26th of 2011, and so you can see how this truly acted as an area where if you were simply using this as an identification mark, whether you should be long or short the market, then in this case here, as we got a little bit of conviction from this long-range bar as was coming up in the 2 o'clock in the afternoon time frame on the October 26th, certainly being long would make sense if we just take a look at logical set of swing points to identify expansions as to where this thing could possibly run to. I would come out here to this swing point, down to this swing point, and you can see this thing managed to make it all the way up into the 1.618 area. It got a little bit expanded there, but I would tell you that just simply based on just normal expansions that you would want to consider tightening up your stop and let the market take you out of this trade. So I'm going to switch back over to the presentation now, and you've got all of those, all of the 2011 Perigee and Apogee. And as we take a look at lunar phases, because many lunar phases have, in essence, stopped working as far as trigger points. So what I have been doing is going back and taking a look at other ways to utilize these lunar phases. And what I identified was Apogee and Perigee still are working very well for us, or very well in order to be able to make some trading decisions. So let's go flip back to the markets here real quickly, and then we'll go take a look at no reason to flip back to the markets right now. Give me a minute to get back to the presentation. Okay, so what I wanted to do was come into the P index dates. Well, actually, let me go. Yeah, so I'm going to come back to the P index dates. It's at 3:35 already. So what we do have coming up on the 21st is a planetary index date. Now, as I mentioned in the newsletter, I've mentioned this on some of the other webcasts, that what I've done is I've gone out and paid quite a bit of money in order to have the ephemeris digitized. In what I'm able to do with that is I'm able to overlay certain planetary aspects on charts relatively quickly to get an idea as to whether or not that set of planets, if you will, that alignments or P-index dates, seem to be having any kind of impact. Is there any kind of trading edge or trading probability that we can take a look at? Now, all of the work that was originally done by Larry Pesavento, Dr. Ruth Miller, and a couple of other folks out there was all done based on ephemeris time. And and it's all over a 24-hour period, but it was all based on ephemeris time. It was all based on taking a look at the number of planetary alignments that existed on those days. We trade the U.S. markets here. I know we do have international clients that are either on with us now or will be listening to the archive. but our markets are open based on Eastern Standard Time. So what I did was went back and took a look at just simply 24-hour periods, just using Eastern Standard Time. So I have both the ephemeris time, number of planets that occur during the day, and I have Eastern Standard Time. I do have it broken down into what I'll call old aspects. So give me one moment here. Let me just I need to grab a sip of water. Thanks. Sorry about that. And so what I've done, the original work that Larry and Dr. Miller did not include some of the planets that are in this new American ephemeris, 2007-2020, such as Ceres, Pallas, Juno, Vesta. And so their work was just simply done with the planets of Pluto, Neptune, Uranus, Saturn, Jupiter, Mars, Venus, Mercury. And their work, because I digitized the ephemeris is updated in trying to keep things parallel. The original work that Larry and Dr. Ruth did was they identified anomalies, and I'll just punch up that page here right now so we take a look at their original work. We take a look at their original work. It was based on a series of distributions of this first set of columns right here, this area. And what they identified was that if you had 3 or less, as they applied them to the charts, or you had 14 or more planets occurring on one day, that those were your anomalies. Now, as you'll notice here, you'll see that in utilizing 3 planetary alignments, you know, that the percentage here is relatively high compared to all of the other percentages down here. And in fact, one could argue, why would you use 3 when 13 planets or so occur less than a number from a percentage standpoint, than what the original work that was done. Of course, since the original work was done versus now, it's much easier for us to, once you have all the information digitally in a database, very easy to go pull out this information here and maybe analyze a little bit further. Also, what I've done is I've done this for a study of just simply 300 years. I could do it for 5,000 years if I wanted, but I just simply ran the numbers for 300 years and felt that 109,000 events plus was good enough for me to determine what the real anomalies were. So as I mentioned to you, I took the ephemeris time and backed everything up for Eastern Standard Time just to understand, if there was any other distribution of events that were occurring. And you can see, as I go back to this chart right here, that if we just simply were going to use the original work that was done by Larry, by Dr. Ruth, and we were just simply using the old aspects as number 13, that would not show up as a planetary index day. And in fact, here I think on a couple of the emails I had highlighted this here, but I just simply didn't realize that the column heading, which was the new aspects, and if you go back here for 14 under new aspects. Eastern Standard, where is it? Eastern, let me go back. I'm confusing myself here. Ephemeris time, new aspects. Thank you. And we go back to ephemeris time. Ephemeris time with all new aspects. 14 is not a date that would have shown up. So here's where being able to go back things up and identify things based on the Eastern Standard Time Zone. And here what we have in a 24-hour period of time, you've got 18 planetary alignments. These are the same planetary alignments that, if you were to take a look in the Daily Exspectarian, you would have made a decision or a judgment on. And so as we come back to the distribution of alignment, what you're going to see here, again, let me just make sure that we're using the right thing. So we're looking at Eastern Standard Time, new aspects, and as we come to look at this, we would be using Eastern Standard Time, all new aspects. 18 shows that only 157 occurring during a 300-year period of time, or only 14.14% of the time. So clearly a anomaly, especially when you start taking a look at the large number here, because, you can go, the maximum number was 25 alignments in one day using the Eastern Standard Time. So you can see that as, from an 18, it's relatively, it's quite a anomaly. So all that being said, just wanted to make sure I gave you the background on that. That was probably longest way to describe that information to you. Here are a list, just simply going back to 1930. Some of you may have charts, Dow charts, or your charting software may go back to the 1930s, and if you want to, you can overlay these dates to identify whether or not they fell into a range of making a market high or low. Again, folks, what we're taking a look at here is, unlike where we were taking a look at the perigee and apogee and using the exact timing of that and drawing a line, this here is used more of a range where it's going to occur on a couple of days on either side. How you use this is not a matter of whether the market is, this does not identify whether you're going to have a high or a low. What you're doing as you're coming into one of these days is you're seeing, is the market working down, or is the market working up as you're coming into one of these days? So let's just go back now so that you've got all of these days here, and let's take a look at the I thought I had this in order. This has got 86. Apparently I don't have this in order, so I apologize for that. But here we have a chart where we've got 4 P-index days. You can see in 1986 and 1987 quite a bit of activity. We go through time periods where there's no activity whatsoever. And, June 1st, the market was moving down in 1987, and this certainly acted to identify a swing point low, if you will. The January 29th, 1987 really didn't. That didn't work. If you take a look at July 2nd, 1986, absolutely, it identified you had the market drifting up north, and you had this act as a swing point. If you take a look at June in 1986, you can see market was moving down into it, and acted as an intermediary point. Let's come back to the next chart that I show here. Maybe I get back in line. No, 1988 looks like is where I'm at. I'm in the 1988 time frame. In this case here, the market just simply moving sideways. But you can see how being able to identify this point let you know if you were really on the right side of the trade. So I think that an 18 planetary index date here, to me, we had 3 out of 4, I think, work on the prior page, that gave us some pretty clear information. So we had 3 out of 4 there. I think this one here is a way that we would have been able to use that information to have marked a short-term trend change. If you come back to this one here, which is 1999, looks like February 2nd of 1999, and you can see how this area here, certainly with the market moved down into it, if you will. And again, some of this is really just subjective. It may be a matter of waiting to see how utilizing this. You may take a trade for whatever reason, but I think you need to be aware of these points. And when the market moves against you, you have a pretty good indication that that's telling you that you're likely really wrong on the trading decision, and time to tighten up the stops. If we come back, take a look at this next chart here from May of 2000. You can see how, as the market were moving down into this time frame, how this acted as a market turn. Clearly, the market was moving down here. I haven't gone through and done a study to understand just how long that they can work. I believe that once you're in a trade, you manage that trade based on you use the P-index dates, just as we have been using the lunar cycles as a trigger to enter the trade, but then you use your other Fibonacci expansion, contraction, swing point volume to manage the trade from that point forward. As we continue to move down into the next series of charts here, you've got December 15th, and I would say in this December 15th, you had the market moving down into it, and I would say that it didn't really, this one here did not work. So December 15th, 2002, I'm not going to sit here and try to kid you. It's in the mid-stroke here, so I can't even say that, it was around trying to make a high or low. This one just simply failed, in my opinion, and take a look at the chart. In this case here, January 13, 2005, I would really say really the same thing. I can't see how, in this case here, utilizing the specific date where it really marked any real short-term or intermediate-term high or low. And what we're looking for here, what we're always looking for, is some type of probability that's going to increase your odds. It's just like the trade update that I sent out today. What I'm looking for as we come into the close here, and it's 3:47, so I want to switch over to take a look at that specifically, that what we're looking for are some real signals to increase our probability. If we can get 3 out of 4 bearish engulfins having tested swing points in the futures contract, being up at highs, to me, that's a probability worth taking a 1% risk. Even though I do believe that the better side of this trade is going to be waiting for the market to pull back and looking for longer-term bullish outcomes. So there's nothing that's changed in my newsletter or my thought process as I've gone through, a series of indicators or charts that are out there. In fact, I'm going to go switch over to it now. But hopefully you have the idea here. Let me just flip through charts real quickly. Hopefully you have the idea of the power of these planetary index dates. Certainly going ahead and being able to back this up to the Eastern Standard Time Zone. We would have otherwise gone through February 21st, assuming that there was going to be no potential activity. One of the questions that did come in was really, and we'll cover this in the next. I'll cover this next time around because. Actually, maybe let me cover it now because coming in around February 21st is the most conjunctive period that we have in 2012, where we have 4 conjunctions that are taking place. The question, if you took a look at the client questions that popped up, were why was I showing the August 87 conjunctions when the market didn't crash until October? The reason is because we use these as timing. What you'll see is this conjunctive period, if you go back to August of 87 on the chart, and you can take a look at that, I believe, in the chart that I include, you'll see that it marked a high in the market. So these areas here, they don't identify a crash or anything like that. What they do is they identify, just as a planetary index date does, they identify, tops or bottoms in the market. You then, from where it goes, you have to, use your trading. You have to use it, your trading decisions. So they're just simply to be used as fuses, if you will. So hopefully that helps to answer that question. So let's go back to the ETF indices here, and let's take a look and see where we're at in these markets. Because this is where I was suggesting that we would go ahead and get in a trade. Now, the closer you can get to 4 o'clock, even if you wanted to buy after hours, just to wait for a indication here, that also would be okay with me. So as we take a look at the SPYs, the number here looks like we're going to have a bearish engulfing on the SPYs. Because obviously anything can happen here in the next 11 minutes, but it looks to me like on the SPYs, we're good to go and that we have our signal. We absolutely have our signal here in the small caps, and from the standpoint, if we take a look at the volume, 51 million shares, and that is trading into 46 million shares. So we're trading inside the swing point from February 2nd, so that has a go signal. If we take a look at the diamonds, other than the market really pushing up, we have the diamonds giving us a signal that we should go ahead and take the trade in the TZA. And again, we're taking the trade in the TZA. I expect when we went long the TZA through the TNA, because we had those strong patterns, both a Gertley sell pattern and a butterfly sell pattern that failed, that we would see a stronger bounce out of that. So the icing on the cake with regard to bearish engulfings is the Qs, and the Qs here, what we need is for the Qs to close out below 62.90, trading out at 62.81. So my recommendation at 350, folks, let's go down just simply to the 10-minute charts here real quickly, just see if there's any volume aspects that are unusual or sticking out at us, or any type of sell-off. So we see, in the SPYs, we had a little bit of a push-up with volume in the last 10-minute trading session, but I don't see anything significant there. So it looks to me like we should take the TZA trade. Right now it's trading out at 1942. There may be some folks that had placed that didn't have the opportunity to be on the call or couldn't manage a trade, and they may have gotten in at the 1950 level. I do have a much wider stop, which means that the position size that we have, would be slightly smaller. But we are getting the type of signals. The other signals, that we were looking at, folks, I was taking a look at the index futures. And on the futures, we did get the completion. Let me just shrink these windows down to make it a little bit easier. We did get the completion. Sorry for the speed of this thing. We did get the completion here on the Dow futures. We completed this pattern here, this tiger butterfly that completed. It did get up over the May 2nd swing point. The real beauty here would be for the Dow futures to close below 12,732, because then we'd be back underneath. You'd have a complete rejection of that swing point. But we did test those highs, and we've been waiting for that. If we go ahead and I punch up the ES Mini, we still have not broken through. And interesting enough, if you take a look at where the ES Mini traded down to, it traded right down into this trend line. So we're still inside this wedge here. But with the bearish engulfing patterns that we see on the ETFs, to me, that is the signal to go ahead and take that trade. So we'll come back over here to the ETF. So there's about 4 or 5 minutes left here. Let me go ahead and take any questions that you might have out there. So if anybody does have any questions, please go ahead and type one into the system. In the meantime, I'll just go ahead and babble. I will go ahead and I'll pull up the Apple chart, though. Let's take a look at the Apple chart to see what Apple is doing out here. Oh, now there's the beauty. Okay, so now you got Apple at all-time highs. I would almost consider taking a trade on the Qs going short, because what does this candle tell you? This tells you that you've got a bearish engulfing candle on Apple itself, having been the leader. So now actually being short even the SPYs or the Qs. But the weakest, when we go short, what we do want to do is we want to short the weakest, the weakest player. In this case here, I've taken just simply a trade on the weakest index out there, which has been the small caps. As I say, what I'm looking for is whatever the pullback is. I'm looking for it to be just a correction, and we'll be spending more time taking a look at a number of different things that have broken out, and to come up with some new trades for us. Unless there's something else that the market tells us. So I think we have everything that we could have asked for in order to be able to get us into trade, other than just waiting out the next 6 minutes to see what might happen in the market. So I don't see any questions. And as always, feel free to give me a call. You can always reach me here in the office, when I'm not on the radio. Or you can always reach me on my cell phone. Anyone that's received an email from me, my cell phone number is included in the email. You have access to me by email as well. So thanks for being here today. Sorry for the initial glitch that we had, and have a great evening. Take care, folks. Bye-bye.